When central bankers discuss the risks of digital currencies, the conversation almost always gravitates toward a single, terrifying scenario: the sudden withdrawal of deposits. Institutions like the Federal Reserve explicitly warn about this specific disintermediation risk. The fear is that a frictionless digital alternative makes it too easy for depositors to flee, triggering a rapid liquidity crisis. A working paper from the Office of Financial Research points to a completely different mechanism of failure: the slow, invisible decay of bank equity. Even if a digital currency is perfectly stable and completely immune to runs, it introduces fierce competition for household funds. To keep depositors from leaving, banks are forced to offer much higher interest rates, which systematically compresses their deposit spreads. Without those wide margins, a bank loses its mathematical capacity to recapitalize after routine economic shocks. The result is a banking sector that slowly bleeds its capacity to absorb losses. By competing directly with bank liabilities, perfectly stable digital currencies radically increase the probability of a systemic financial crisis. To understand why a bank's survival depends heavily on deposit interest rates, we have to establish the baseline of fractional reserve banking. This structure dates back to the 17th century London goldsmiths. Originally, goldsmiths charged a fee to store physical wealth in secure vaults, but they soon realized that clients rarely demanded their gold at the exact same time. They began issuing paper receipts against a fraction of actual reserves, effectively creating credit. This is the foundation of the modern money multiplier, mathematically represented as 1 over the reserve ratio. Banks issue highly liquid liabilities, deposits, to fund the purchase of highly illiquid, long-term productive assets. This multiplier system drives modern economic growth by channeling idle savings into productive investments. But it requires the banking sector to consistently manage and absorb aggregate macroeconomic shocks to the value of those long-term assets. Because banks fund these investments with a massive ratio of debt to equity, any drop in asset value hits their capital buffer with multiplied force. Fractional reserve banking permanently exposes the sector to leverage-driven fragility. Macroeconomists analyze this exact fragility using a continuous time stochastic model, a mathematical framework that maps out the nonlinear global dynamics of the economy over time. This dynamic T-account visualizes the aggregate banking sector in the model. On the left side, we have productive capital, represented by the variable y. This is balanced on the right by a large block of short-term liabilities, or deposits, and a thin, critical layer of equity, denoted as N. In this framework, equity behaves very differently than deposits. The model introduces a severe financial friction. Raising new equity during a downturn is prohibitively expensive, modeled here with a marginal issuance cost of 100. Because selling new shares to the public in a crisis is mathematically unviable, banks are effectively locked out of the equity markets when they need them most. That leaves cheap, risk-free deposits as their only reliable marginal source of funding. Banks are trapped by their own capital structure. They cannot dilute their way out of a severe crisis. Their capacity to survive a shock and maintain their holdings of productive capital depends entirely on the profitability of their deposit base. When an exogenous Brownian macroeconomic shock hits the system, represented in the equations as DWT, it damages the value of the productive assets held on the left side of the ledger. Because the bank is highly leveraged, a small fractional loss in the value of the productive capital creates a massive proportional drop in that locked equity tier. This chart graphs the system's natural healing mechanism. It plots system drift, the speed at which banks recover equity, on the y-axis, against total bank equity on the x-axis. Notice how the line curves sharply upward at the far left, indicating a high recovery rate precisely when equity levels are critically low. This recovery is driven entirely by the deposit spread. Because bank deposits provide immense daily liquidity utility to households, banks can get away with paying interest rates far below the risk-free rate, generating consistent excess returns. During bad times, a flight to safety occurs. The demand for safe, liquid deposits spikes, and the deposit spread mechanically widens. Banks generate high excess returns exactly when they are in the most desperate need of organic capital. As long as banks hold a monopoly on liquidity provision, the widened spread acts as a replenishing cash flow. The fractional banking sector is an inherently self-healing system. That self-healing dynamic shatters the moment a perfectly stable, run-proof digital currency enters the market. The OFR researchers calibrate the elasticity of substitution between deposits and digital currency at 5.3. In simple terms, households view this new digital asset as a highly viable, near-perfect substitute for traditional bank deposits. As wealth migrates into digital wallets, banks lose their captive audience. To stem the bleeding and retain the funding required to hold their assets, banks have no choice but to offer significantly higher interest rates to depositors. The math is unforgiving. The deposit spread collapses, permanently severing the bank's ability to generate the excess returns required to heal its equity after a shock. Unable to rebuild their capital buffers through internal profits, banks enter a systemic deleveraging spiral. To avoid bankruptcy, they are forced to rapidly shrink their balance sheets. This graph plots the asset price against bank equity, visualizing the consequence of that deleveraging. As equity moves left into the distress zone, banks are forced to fire sale their productive capital to households. Because households lack the specialized productivity advantage of banks, this causes severe economic misallocation, and the asset price plummets sharply. The introduction of a digital currency doesn't trigger a sudden, chaotic run on the bank. Instead, it causes a slow, fatal starvation of the bank's equity rebuilding engine. The theoretical model maps the mechanism, but the hard quantitative data from the OFR's baseline calibration reveals the precise scale of the damage. This table compares the baseline economy to an 18% digital currency environment. The probability of crisis jumps from 2.99 to 5.97%, doubling the risk of systemic failure. And contrary to static models, average bank equity definitively drops from 11.5 to 10.2%. Here we encounter the central paradox of the paper. Despite this immense macroeconomic damage and the doubling of crisis probability, total household welfare actually increases by nearly 3% in consumption equivalent terms. This happens because crises, while severe, are rare events. Households suffer steep output drops during a fire sale, but they gain massive, continuous utility every single day from the superior, cheaper liquidity services provided by the digital currency. The localized daily benefits of a highly efficient digital payment system mask the deep structural vulnerabilities it quietly weaves into the wider macroeconomy. This dual-axis graph illustrates the inevitable political economy conflict created by that paradox. The blue line shows household welfare climbing steadily as digital currency expands, while the red line shows bank equity valuations simultaneously crashing downward by nearly 7%. This divergence exposes a classic market failure. Private stablecoin issuers and the users who adopt them do not internalize the macroeconomic costs of the banking sector's financial frictions. They only see the immediate utility of the transaction. Because the private profits from issuing digital currency are high, a competitive free market will inevitably overissue stablecoins, pushing the supply far beyond what is socially optimal for long-term economic stability. Effective regulation requires a guarantee that stablecoins are fully backed by safe assets, alongside a hard limit on their total market volume. This ceiling prevents digital currencies from entirely cannibalizing the bank deposits that fund the real economy. Even a perfectly backed, cryptographically secure, run-proof digital currency carries a hidden systemic cost. Maintaining global financial stability means protecting a mechanism that is entirely unglamorous but structurally vital: the friction of the bank deposit